Hey everyone, Joe from CrossCountry Mortgage. So today we're going to be talking about the loan estimate. This is probably the most important document that you're going to receive from your lender. It's equivalent to your purchase and sale contract with the seller of the property. This is the contract between you and your lender. All right, so let's start with page 1 of the loan estimate. At the very top, you're going to see the lender's name or broker's name along with the property address for that lender broker. Directly below that, you'll see the word loan estimate in bold, and then below that, the date the loan estimate was issued. In this case, this is a loan estimate I created today, 1/12/2023. Below that, you're going to see the applicant's name. In this case, I used John Homeowner with a 123 Any Street address. Below that, you're seeing the property address. Now, this is the subject property address, and it should match either your property address if it's a refinance or the property that you're purchasing. And directly below that is the sales price of the property. This should match the sales price on the contract. Moving to the right-hand side at the top box, you're going to see the loan term. This can be any term between 5, 10, 15, 20, but the most commonly seen is a 30-year mortgage. Below that talks about the loan purpose. Is this a purchase? Is it a refinance? In this case, this is a purchase loan estimate. Below that, you're going to see the product type. Is it a fixed rate? Is it an adjustable rate? Is this a balloon? Is this a reverse mortgage? Below that, loan type. You'll see there are 3 blocks there: conventional, FHA, VA, and an open block. Those are for other non-ordinary mortgages. And below that, you're going to see your loan ID. Just below the loan ID, you're going to see the rate lock. This is very important, especially when you're comparing multiple lenders to determine whether or not your rate has been locked. In this case, as you can see in the example, the rate has been locked and it's valid through February 13th. This is where you need to compare your rate lock with your date of closing to make sure the rate is locked for a long enough period to cover you through closing. And then below that, you're going to see the estimated closing costs. General rule of thumb is those are going to expire within 10 days if you don't sign this loan estimate. Once you sign this loan estimate, acknowledging that you've received it, then those costs are generally fixed. We'll get into the cost later in the loan. All right, let's talk about part 2, the loan terms. At the very top, you can see loan terms on the left, and can this amount increase after closing on the right. These are very important, especially when we're talking about adjustable rate loans, interest rates that haven't been locked. So at the very top, you're going to see the loan amount. In this case, it's $472,500. And can this amount change after closing? Absolutely not. Interest rate is at 6.99. Can this change after closing? It's a no. If this was an adjustable rate mortgage, it would say yes. Monthly principal and interest. This is the projected principal and interest payment only. You can see the numbers there, and that number will not change. Remind you, that's only principal and interest, and that's because this is a 30-year fixed loan. If this was an adjustable rate mortgage, this payment could change. Prepayment penalty. Does this loan have a prepayment penalty? I get this question all the time, right? Majority of government loans through Fannie, Freddie, and Ginnie Mae, so your standard conventional FHA and VA loans will not have a prepayment penalty. Moving down, does this have a balloon payment? Again, if you're doing a traditional conventional FHA, VA loan, no, there will not be a balloon payment, but it's essential that you read through this. All right, so let's talk about the projected payment section. In here, you're going to see broken down the principal and interest, which should match the same amount in the previous section that we covered. And below that, if your loan has mortgage insurance, you will see the mortgage insurance. And as you can see, this loan does have mortgage insurance, which is why you'll see the years 1 through 10 and 11 through 30. That's because this loan is we're anticipating the mortgage insurance to fall off in and around year 10. So it does not continue beyond year 10. Below that, you'll see your estimated escrow. Again, this is an estimated amount that the lender has to disclose in good faith. These numbers may change depending on final taxes and insurance that we receive. You as the consumer get to shop for insurance, and your taxes will come directly from the county tax assessor and will be included in your title report. And below that, you see the estimated total monthly payment. And below that is estimated taxes, insurance, and assessments. As you can see, this amount can change over time because this is out of the lender's control. the estimated taxes or insurance, as you can see on the right, and then whether or not they're included in escrow. Again, this total amount may change over time. So the last section on page 1 of the loan estimate talks about cost at closing. In the first block, you'll see estimated closing costs. And there's a very substantial large number there. That's the total cost. That includes loan cost, other cost, and whether or not there's any lender credits. Don't freak out. We're going to cover this more in page 2. And then at the very bottom, you'll see your estimated cash to close. This is an estimate as final invoices, taxes, insurance, and other items are updated in the loan. This number may change, but should not change very much as long as the lender issued this number in good faith. All right, so let's look at page 2 of the loan estimate. First of all, I want to say paragraph A and B is the only part of this entire loan estimate that the lender has total control over. Paragraph A are the lender fees. In this paragraph, you'll see what the lender is charging you for the loan. In this situation, you can see discount points, buying down the rate, processing, and underwriting fees. And the total lender fees are included in the top under paragraph A, origination charges. Paragraph B are services you cannot shop for. These are, again, part of your loan costs, but they're third-party providers selected by the lender. You don't have a choice. It's who the lender has contracted services from. This includes the appraisal, the credit report, and the flood certification fee. Also, you'll see lenders include other enterprise fees, things like technology fees, and other services that you cannot select because the lender has a contract with that servicer. So let's talk about paragraph C, services you can shop for. These are typically going to include your title and attorney fees. If this is a purchase, it should match the fees of the title company or attorney that's written in your sales contract. But be aware, not all lenders have familiarity working with the attorney on your purchase contract. So these fees can vary significantly. I'd highly encourage you get a fee sheet from the attorney or title company selected and compare that with the loan estimate. Paragraph D, as you can see, just combines paragraph A, B, and C together and gives you the total cost of those 3 columns. So let's move to the right-hand column of the loan estimate and talk about other costs. In paragraph E, you're going to see taxes and other government fees. Now, these aren't property taxes. These are taxes imposed by the state government or county for transferring a property, commonly referred to as transfer tax, recording fees, and other fees. Now move into paragraph F. This is your prepaids. You'll see on there the total amount, and in this case, you'll see homeowners insurance is estimated at an annual premium of $1,500 a year. Below that, you'll see the prepaid interest on the loan. We can cover prepaid interest in another segment. All right, so let's look at paragraph G, initial escrow payment at closing. In this case, you can see for the homeowners insurance, we're adding an additional 3 months to the escrow account, and we're collecting for 6 months of property taxes. Again, I'd like to do a separate segment on escrow accounts and how those work. Moving to paragraph H, you're going to see owner's title insurance, very similar to C, which is lender's title insurance, but this is optional for you as the homeowner. And then paragraph I. Paragraph I, much like paragraph D, just adds up paragraphs E, F, G, and H, which brings us down to paragraph J, your total closing cost. If we put all these columns, A through I, together, those are the total closing cost. And directly below that, if there are any lender credits, those would be reflected in paragraph J. All right, so let's talk about the bottom line, calculating cash to close. This is one of the important parts. Look at your total closing cost carried down from paragraph J. Below that, how much money are you bringing for your down payment? And then any additional deposits you have. For example, earnest money. In this case, if you were receiving credits from the seller towards your closing costs or any other adjustments, they would be reflected here. Add and subtract as appropriate, and that's going to bring us to our bottom line, estimated cash to close. This is what you are expected to bring to the attorney or title company on the day of closing. So let's cover page 3. This is the last page of the loan estimate. At the very top left-hand corner, you'll see who the lender is. This should be your loan officer. And on the right-hand side, if you're going through a broker, their information will be on the right-hand side. In this case, we'll move down to comparisons, and it talks about in 5 years, the total amount you'll have paid in both principal, interest, mortgage insurance, and loan cost versus the total amount of principal that you've paid off. Yes, it is a very upsetting number. Next, we'll move into your annual percentage rate. The APR can be quite confusing. As we discussed on page 1, what your interest rate is, the annual percentage rate, and calculates all those additional costs to include mortgage insurance, title, recording fees, and so it gives you a total cost of the loan if it was calculated from a dollar amount to a percentage. And then at the very bottom, total interest percentage. This would assume that you're paying this loan on time with no additional payments over the full 30 years. This is the percentage of the loan that you would have totally paid back. So in this case, if we had borrowed $300,000, we'd be paying back a total of 139.52%. Moving down to the bottom, other considerations, you'll see some disclaimers in there about appraisal. Assumptions, typically if it's not a government loan, so if it's not an FHA or VA loan, an assumption will not be allowed. And so you'll see there whether or not an assumption is authorized with this loan. And then the last block, it talks about servicing, whether or not the lender intends to hold or transfer your servicing. By default, most lenders will disclose that they intend to transfer the servicing of your loan, and this protects them. Though we service our loans, in the event we decide to transfer that servicing, we are not restricted by this contract. So hopefully this helps you as you're reviewing your loan estimate. And I ask that if you have any questions or comments, drop them below and follow us on our YouTube channel for more instructional videos.